Hey everyone, and welcome to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. This week, I'm speaking with George Milling-Stanley, who's the Chief Gold Strategist for State Street Global Advisors. George, great to have you on the show.
Hi, Sumit. Thanks for inviting me.
Absolutely. So I want to start right at the top, George. Everyone's been watching gold. It's had this tremendous rally this year, hitting record high after record high. Last I checked, it's up 27% year to date. What has driven this rally?
I think there are really three things behind it. The first is that central banks have continued to be very strong buyers. Primarily, this is central banks in the emerging markets who are overexposed to US debt in their official reserves and underexposed to gold. That's been a phenomenon of the last 14 years, and that's not going to go away anytime soon. The second thing, we've seen a big revival in Chinese investment demand. I think mostly because Chinese investors are frightened of their stock market after all the problems that hit the real estate sector. And the third thing, a big revival in Western world investment. Western Europe and North America have been major investors in gold. I think those are the three things that have pushed prices to this succession of all-time highs we've seen this year.
George, I took a look at the long-term gold chart earlier today ahead of this interview, and I noticed that gold was essentially flat for something like 12 years. And then you suddenly see this big breakout this year. Have we seen periods like this in the past where gold consolidated for a long time, then made a big move higher? And if that's the case, what do we typically see? How high can prices go?
The last question is really the most important one, but let's deal with the run up to that. You're right that gold prices have been pretty stable up until 2024. I think the issue here was the price was finding it very difficult to get through overhead resistance at around about the $2,000 an ounce level. That was a level a lot of speculators set as the place to take profits in gold for most of the last 6, 7, 8 years. But we finally made that definitive breach through the $2,000 an ounce level at the beginning of this year, I think because of the three things that I mentioned: central bank buying, Chinese investment, and Western world investment. And I think we've gone from strength to strength. As to how much further we're going to go, we're up 27, 28% year to date. I think that's pretty good. The next question is, where is the overhead resistance? And the speculators are still pushing the price up to see if there is any resistance up above the current level of prices. So we really don't know where that next level of resistance will be. We've seen this from time to time before. Gold took a long time to get through the previous all-time high, set all the way back in 1980 at $850 an ounce. It flirted with that level for quite a long period and then took off and really rose like an express train. Similarly, when we broke through the $1,000 an ounce level about 12 years ago, again, gold took off like an express train once we had made a serious breach of that level. And that's exactly what we've seen here. We broke through that $2,000 level early in the year, and here we are above 2,600, and with still, I think, a good deal of upside momentum to the price.
George, in the ETF world, it looks like interest in gold is starting to pick up. We're seeing some inflows into the gold ETFs lately. How should the average investor be approaching gold? Is it too late to buy? And, how much of, one's portfolio would you recommend allocating to gold?
First of all, I've never met the average investor, and I very much doubt whether you have as well. I don't think there is such an animal. The literature basically suggests any portfolio, whether it's central bank, can benefit from a long-term strategic allocation to gold somewhere between 2 and 10%. And that if you are anticipating or already experiencing a period of exceptional turbulence in financial markets in general, it can make sense to double that allocation. So here we are with a broad spectrum somewhere between 2 and 20%. Where an individual investor fits on that spectrum is going to depend upon that investor's tolerance for risk, that investor's needs for liquidity, and a whole bunch of other things that advisors to those investors need to know. They need to know their customers. It's a legal requirement these days that they must know their customers. And the financial advisors are going to be the ones who can decide where on that spectrum between 2 and 20% and any particular investor is likely to fit.
This is obviously a very exciting time for gold, a very bullish environment. But I have to ask you, George, about the risks. What are the risks that could knock gold down from here?
It's really hard to envisage what could actually happen. I mean, the logical things are we could have an outbreak of peace around the world. We could have geopolitical calm rather than the kind of geopolitical turbulence that we currently have, whether it's the war in Europe or the war in the Middle East or the potential for conflict in the Far East. All of those things I think are currently unlikely. There's very, very little progress in people who are trying to organize peace talks in the various conflicts around the world. The other thing, if the dollar were to turn around and to start to soar again, as it did in 2022, when it reached a 20-year high against just about every other currency in the world, then that might well be a headwind for gold. But it's very difficult to see the dollar turning around and going up now that the Fed has actually started to cut rates with a 50 basis point cut recently, and with a commitment to continue to reduce interest rates for at least the whole of further this year and for at least the whole of 2025. So it's very difficult to see what could actually amount to a headwind for gold in that kind of macroeconomic and geopolitical environment.
Final question, George. Obviously, this year is all about gold. People are bullish on gold. There's a lot of excitement there. But in years past, say the last 3-5 years, gold seemed to be overshadowed by Bitcoin, which is considered this other type of alternative asset slash safe haven. Bitcoin, it's kind of been flattish, recently, while gold has taken off. Do you think both of these assets can coexist and thrive?
Oh, I think there's no question that these assets can coexist in a portfolio. I think they do very different functions. The primary function of gold is to offer you protection. It offers you diversification against the normal things that you'd find in any particular portfolio. It offers you protection against potential inflation, potential weakness in the equity market, and potential currency depreciation, whatever currency you're actually working in. So those are the things that gold offers primarily. But gold also, from time to time, not always, but from time to time, offers to enhance the returns of a properly balanced portfolio. And it certainly seems like 2024 is one of those times when we have that performance enhancement. So protection plus performance, that's not really a bad mantra to have. I think with Bitcoin, the returns have been very, very good in the short history of Bitcoin. I love representing an asset with a 6,000-year track record. The returns up for Bitcoin have been very good, except for 2022, when there were some negative returns. But I think any investor who wants to invest in Bitcoin should remember that he or she is probably increasing the risk in the portfolio, increasing the volatility of the portfolio because of the volatility in the underlying Bitcoin. And if you're going to increase the risk in your portfolio, then it makes sense to reconsider and possibly readjust your exposure to risk-off assets such as gold. I think the two can coexist because they do different jobs, Sumit.
Fantastic. Well, we're going to have to leave it there, George. It's been an absolute pleasure. Thanks so much for your time.
Thank you. I really appreciate the opportunity. Thank you, Sumit.